Where are the best dividend values today? We're here with Josh Peters, who's going to tell us.
Yeah, there's an awful lot of interest in dividend-paying stocks right now, in part because people are still nervous about the economy. It doesn't really seem to be growing. There's still a lot of risk out there, whether it's Europe, the U.S. fiscal cliff, you name it. But interest rates are so low, people don't want to stick with bonds. They can't get a decent inflation hedge or any kind of real return there. Even though bonds are still very popular, dividend-paying stocks really offer you the best of both worlds. You can get income that in a lot of cases is better than what you can get on high-grade bonds, and you're also getting that hedge against inflation. Your income can grow as fast or faster than inflation over time with some of your better dividend-paying stocks.
Yeah, and it seems that back before in the dot-com era, people were always talking about growth as the new income. And now you have income as the new growth to a certain extent, because you have a lot of stocks, especially in the tech sector now, that have gone from these traditional roles as growth companies into more fiscally responsible dividend-paying stocks like Microsoft.
They've had to mature, they've had to grow up. Some of these companies I think of as being kind of overgrown teenagers, where maybe they've bulked their businesses up into their final form, but maybe the emotional maturity isn't quite there yet.
Sure.
You look at a company like General Mills, been paying dividends for 114 years. You don't have to wonder what their corporate priorities really are. They're there to pay that dividend, keep raising that dividend. A lot of the tech sector companies, you wonder whether they really get it yet. Because even back in the 1990s, dividends were still important. Dividends have never lost their value because that's how stocks pay their owners back and provide a real return. And historically, they've been a very important part, accounted for the bulk of equity returns. They're going to be that way in the future. And what you want to do is you just follow the baby boom generation. Their priorities as they have moved through their chapters in American history explain what's going on in the market. 80s, 90s, that's their peak earning and savings years. They want growth, capital appreciation, capital accumulation. Now they're retiring. They want income. The stock market's going to respond to that. It's going to be less about growth. There's still going to be growth, but it's going to be less about growth and more about income, and that's how you want to position yourself.
Are there any income stocks that you like out there in particular at this point? Because I know this has been quite a trend, so some of them are overvalued, some of them you just have yield hunters that are out there looking for the biggest yield, which isn't the best way to go. Yeah,
you don't want the highest yield. You look at some stocks, like specialty financials or mortgage REITs that claim to have 15% yields. Now that's the market telling you that either there's a huge amount of risk that the dividend's going to be cut, or it's almost a foregone conclusion. There's no free lunch. And then you get into safer dividend yields, let's say those that are kind of in the 4, 5, 6% range. Some great companies like Altria Group, Realty Income in the real estate investment trust sector. But those stocks are looking a little expensive right now. I think you want to keep an eye on them, but wait for a pullback. Where I'm finding the best value right now is with very solid companies that are paying 3 to 4% yields, that are raising their dividend every year or almost every year, raising it at a good 7, 8, 9, 10% type of long-term average rate. You're not getting the fattest income yield up front, but you're going to get the best total return.
So you have the sustainability. Do you have an example of one of those companies?
General Mills is one. Yields about 3.3%. I think that dividend continues to grow 7, 8, 9% a year going many years in the future. You think about that rule of 72. If it grows 8% a year in 9 years, the yield is doubled on your original investment. So that 3.3% becomes 6.6. A bond's not going to do that for you. Even a lot of these higher yielding stocks that might be 5, 6% aren't going to do that for you either. General Mills can drive that total return. Chevron, similar type of math, yield in the low 3% range, but they're investing a huge amount of the earnings of the company, which are really high right now because of where commodity prices are at, back into growing production for many years in the future. That's going to enable Chevron to keep raising that dividend year after year after year. You've got a lot of growth to compensate for a little bit lower yield than you might be able to get in some other areas of the market. So those are two of my favorites right now. In the areas I think where you want to be careful, REITs look pretty expensive. Most regulated utilities, fully regulated utilities look a little expensive. You got to be a little bit creative and think in terms of where am I going to be 5 years out? Am I going to look back and be happy with the total return, not just the income?
Sure. Great advice. Thank you very much.
Thank you.
And thank you for watching the MoneyShow.com video network.